So the first thing I would say is that you need to take into account your own goals, your own, personal system in terms of your account size and how much money you have that is outside of your account and things like that when you're coming up with these numbers. And I do think to some degree, it's a very individual thing. Very, very broadly speaking, to the professional prop traders that I have in my team, and then again, everyone should break it down to their own individual unique circumstances. I don't like the idea. I'll start with a full day's worth of risk. I don't like the idea of anyone risking more than 5% of their account in any given day. That would encompass any and all trades that you take in a given day. I think that where you are in your career should determine whether you're taking uniform risk on every trade that you take or whether you are implementing what I call risk skew. For people who are very, very new traders, complete entry level, I like the idea of doing exactly everything uniform. So you risk your 0.5% or 1% on every single trade that you take. And that way you're not focused on anything except the actual trade mechanics. You know exactly how much you're supposed to risk in every trade. So it's one less thought process that you have to go through when you are deciding whether or not you have to put on a trade. Because if you think about it, there's so many things that you actually have to think about when you're putting on a trade. Is this a good trade? What is the trade? Why am I getting in it? Where is my stop loss if I'm wrong? Based on where my stop loss is if I'm wrong, how much tier size should I be taking on that trade in order to risk X amount of dollars, which is the equivalent of that 1% of my account. So the fewer decisions that you can make as a new trader, probably the better, because it enables you to focus more on the trading mechanics and the learning process. After you've probably got, let's say, at least 1 year worth of experience, and this is also going to depend on the trader, but let's say at least 1 year's worth of experience, then you want to begin to implement, maybe even 6 months, you want to begin to implement what I call risk skew. Risk skew is, I think, an extremely important technique for anybody who is a little bit more seasoned of a trader to maximize P&L. Risk skew is the idea of risking more in better trades and risking less in worse trades. Obviously, you're never going to take a trade that doesn't have a positive overall expectancy, meaning the risk reward and probability of success of that trade as you perceive it on any trade that you take should be a positive number, even if some trades will fail, because otherwise the trade's not worth getting into. But there are trades that will have a better risk reward and a higher probability of success than other trades, even if those other not as good trades could make you money if you took them 100 out of 100 times. And the idea of risking more on a better high risk, high reward, better risk reward multiple, better probability of success trade versus lower is called risk skew. And that's when you begin to build in a grading system on your trades. So this is an A+ trade. All the stars are aligning. It's got everything I could possibly want on the side of the trade. The stock is relatively strong. I'm going long. The market's on my side. It got upgraded this morning, so it's in play. It's a great time of the day to be executing this trade, which typically means it's happening in the morning. There was beautiful large institutional option flow that was bullish that was coming in on the stock. You've got all the stars aligning on this trade, and the entry versus stop loss also means that it's a really good risk reward. That's an example of like an A+ trade. Or maybe you have like a C level trade, which is a trade where, again, if you take that trade 100 times, you're going to make money at the end of 100 times. But there's some things that are on the side of the trade. There's some things that are against the trade. It doesn't have quite as good of a risk reward. So therefore, it's not as good of a trade, but it's still worth taking. You should be risking more in the A+ trade and less in the C trade. And that's what risk skew is. So circling back to, I want to risk 5% of my account in any given day. Well, maybe on a genuine A+ trade, you want to risk the entire 5% on that one trade, because that happens so rarely and that risk reward is so greatly in your favor. Still not 100%. Any and all trades, if you trade long enough, I promise, will fail. You could press the button on that A+ buy setup And then next thing you know, a new headline comes out for that company or comes out for the economy or comes out for the market that causes the entire market to crash, and you get stopped out of that A+ trade, and maybe you lose that 5% of your account all on that one trade. But you have to look back at it still after the fact and say, you know what? It was worth it for me to take that, and I just got, you know, hurt because this news came out that I wasn't expecting. And then maybe a C trade is a trade that you want to risk 0.5% of your account on. So you could take 10 C trades over the course of you know, an individual a day. So that is the concept of risk skew, and that will pay you better or worse over time.